Hi. Before we start, I just want to check to make sure we have enough people online. Andrea, how are we doing?
Yep, the numbers are going up.
Okay, so it's a long presentation and I got to condense it, so we'll get started. I'm Dave Bernard with Bertha Kleina, and we're going to kick everything off by hearing from one of our sponsors here at Reset. Emily?
Thank you, Dave. Hello, everybody. I hear we have a big group today, so it's really exciting to think about everybody tuning in from all around the state to hear this really valuable information. At Reset, our mission is to grow this social enterprise sector in Connecticut. We've been doing that for about 15 years now through an impact accelerator and a food incubator, other workshops and programs, including a program in the fall called Measure What Matters to help you navigate the B Corp process. If you have not come to a Reset event yet, I strongly encourage you to do so if you're interested in entrepreneurship. I'll drop the link for our venture showcase, which will be happening at the end of April in the chat channel. It's free, so feel free to just join and see what we're all about. And yeah, we look forward to meeting you. So thank you very much.
And our other sponsor from District New Haven couldn't make it today, but on behalf of them, I just want to say that we're big supporters of both Reset and District New Haven. We also have a satellite office at District New Haven, and it's a great campus environment where people can go and meet other young and growing companies, as well as some advanced companies and investors and advisors. There is a great barbecue restaurant on premises there, as well as a gym. And so it's a great working environment. So consider checking it out if you're looking for office space, if you're looking for a place to meet new people. Sign up on their website. They have lots of events that are very interesting. Not as interesting as this one, but almost. Okay, so we're gonna get started. We have today's presentation is on financing. If that's what you signed up for, great. If you didn't sign up for that and you're somehow here by accident, buckle in and enjoy the ride. And Andrea here, also from North Carolina, is going to help me take questions. She's going to keep an eye on the chat. So as we go through and you have questions, feel free to put your questions in the chat room. She'll let me know and I'll answer them as we go. And not everybody has to stick around, but I'll stick around for a while afterwards to answer questions at the end as well. And then my contact information is on the presentation. You are more than welcome to reach out to me anytime with questions. And even though I'm a lawyer, you will not get a bill. I am just happy to sort of help people through these questions and areas that are not easy to master. And also, Andrew will be sending out to people some information, copies of the presentation afterwards, along with a state list of certain financing opportunities, which I'll discuss during the presentation. So you'll have all that. Now I'm going to try sharing my screen. So assuming I don't blow up the whole thing, just give me one moment. Yes. Okay. Okay. Andrea, did that work? Everybody can see
Yes.
this?
Yep.
Okay. So again, Dave Menard from Bertha Kleina. I'm a business law partner there. I'm also chair of the business and finance practice group. And we have an emerging companies team that works with companies all the time, mentoring them as well as representing them and helping them through various stages. And perhaps the number one issue that comes up with any company is, how the hell am I going to pay for this thing? And there's a lot of different ways. And today we're going to focus a lot on what we call equity financing, but I wanted to walk you through a lot of examples and hopefully make it a little more understandable. And so the fact is for most companies, financing is a little bit scary. And the reason why is because it's not what you do, right? This is something that you really don't have control over. It's something that, it may be a complete anathema to you, but you're learning it. And it's just one of those things that as a CEO of your own company, you really have to embrace learn to speak and adapt is one of the many skills you're going to learn along the way, and part of the fun of the adventure. And if you have attended our sort of legal basics 101 for companies presentation, you know, one of the things that I strongly recommend is that you have a good group of advisors, and that you expand your network and you get to know people. One of the things you should have advisors for are people who understand financing at different levels, and can help guide you along the way. And advisors can be people that you know well. They can be sort of dedicated advisors, but they can also just be people that you know throughout your industries or through networking through events like this one. And you are able to sort of tap those knowledge, and you will find that people in our entrepreneur community are very willing to help out. So I think that's a great thing and available to you. Because you'll be getting whole copies of this presentation, you'll find that I go through some slides a little more quickly than others. I may skip through some. This presentation used to last forever. I've actually put parts of the presentation in appendices at the end because I think it was worth you having the information, but it wasn't worth going through the time. I'll try to hit those as we are. So let's talk about the methods of financing, right? So number one is bootstrapping, basically where you finance it yourself. You put in your own money, and then as the company earns revenues, you grow it. It tends to be a sort of steady but slow method of financing, and it's appropriate for certain companies. All methods of financing, if we're going to go through them, by the way, are heavily based on your goals for your company, your exit strategy. When people ask me what kind of financing should I look at, or how do I get VC financing, I won't even start there. The first thing I ask for is, what does your company do, and what do you want to do with it? And then that will help guide us towards the types of financing that are appropriate for you. So bootstrapping may be applicable. Debt financing may be applicable. We'll talk a little bit about debt, not a lot, but I think it's an important resource and often underutilized. You should check out. Equity financing, we'll get into what that means. Crowdfunding, we'll talk a little bit about cryptocurrency and non-fungible tokens. But you'll see that the biggest parts of this presentation will focus on equity and equity crowdfunding. So let's kick it off with debt financing, all right? So the interesting thing about debt, the good part about debt is that you're not giving up any ownership. You're not giving up control over the company. And honestly, some level of debt financing can be very effective. Nobody wants to take on debt. They think of the, paying back on the debt plus an interest rate, as a burden versus maybe getting some equity financing where they don't have to pay anybody back right away. But what you're giving up when you get equity financing is that level of control, and you're admitting somebody into your business who is in a relationship with you very much like a marriage. I mean, once they're in, and they are, to put it politely, all up in your business. And whether they hold a minority interest or majority interest, they get a say. They get a chance to, talk and be heard and get information on your company. You avoid almost all of that with debt. And so, and there is such thing as good debt. There are debt programs that involve very low interest rates over long periods of time. So it can be very useful. And again, combined with equity financing, it can help you achieve your funding goals without, like I said, giving up certain levels of control. There was a lot of programs available in the state. I highlighted some here. You can also look at Appendix 1 of this presentation, which goes through some other types of debt financing programs in the state and some other funding opportunities generally. Also, the state has produced a list of just about everywhere you can get financing in the state. I don't know that they've updated recently, but we've got a copy of that list, and we will distribute it to you as part of this overall presentation package. So one of the places you should know is the Community Economic Development Fund. So every major bank is required by law to actually make loans to non-bankable companies. And banks usually don't do this requirement directly. What they do is they contribute a certain amount of funds to regional organizations that then handle it. In our case in Connecticut, that is Community Economic Development Fund. What's interesting thing about them is they provide business advisors with all of their debt. So there's actually someone, they stay involved. They're there to help, and they really want to see their company succeed and become bankable. So I think that that's a very useful place to talk to. The Department of Economic and Community Development has programs. They have a small business loan program. Usually their debt is over long term with a very low interest rate, which can be useful. They have some forgivable programs based on job creation, and they have a lot, especially these days, they're heavily focused on opportunity zones. If you can build your business in a depressed area that could use your business, frankly, there may be many more opportunities available to you in terms of financing and tax relief and so on. So anyways, please take that into account, but just consider debt as an option. And that's about the most we're going to say on it, but always happy to answer questions. Okay, so now we're going to get into equity. Equity is ownership in a company. There's a number of regulations that touch on sales of equity. And so I'm going to hit some background information first. The first is that ownership in a company is considered a security for federal securities law purposes and state securities law purposes. And every time a security is sold or transferred, that transfer sale needs to be registered with the federal government and every state government that's involved in the transaction, meaning wherever the residence is that you're selling into or selling from. Or there needs to be an exemption, and even the exemptions most times require filings and filing fees. So whenever you're going to transfer ownership in a company in any respect, you should be consulting probably with an attorney to see whether or not you need to make securities law filings and what's involved in that. By the way, you're always looking for exemptions. A registration means a public offering. And that's a whole nother venture costing hundreds of thousands of dollars. And if you're thinking about an initial public offering, chances are you wouldn't be here at this presentation. We're a little bit early on for that. Equity investing is complex, especially when you get to the venture capital level. But even before that, even equity crowdfunding, it is an alphabet soup of insider terms. There is a language to it, like any specialized industry. You will learn it as you go, but again, don't hesitate to ask questions. Keep your advisors in the know and ask them questions. Okay. You're going to hear from other people, not me, a lot about Delaware C corporations. Like, oh, maybe I should incorporate my company in Delaware, and does it have to be a C corp? And the answer is often no and no for most companies. However, the reason why you hear it is because venture capitalists tend to like to invest in Delaware C corps. They like to invest in C corps because it provides a good tax structure for them. And it doesn't make them a partner in a company as say an LLC would. And that's good, like I said, from a tax perspective. So there's good reasons for them, but you don't need to be a C corp until you get invested by a VC. In fact, they're going to rewrite all of the ownership documentation, all the charter documentation of a company with their own language when they come in. So you literally can convert at the time of the investment, and that's perfectly fine. The other thing about Delaware is that Delaware as a state is kind of interesting. They have an entity called the Chancery Court, and the Chancery Court does nothing but hear business law cases. And they've had the Chancery Court for about 200 years. So as you can imagine, what this means is that the Delaware corporation law is very well detailed. And if there's been an issue with it, chances are it's already been addressed by a court somewhere in Delaware, which is very unlike almost every other state. And that allows for lawyers and clients to predict outcomes when major questions come up. Also, the Delaware legislature reviews their corporate law every year and updates it, which is also extremely unusual. And the reason why they do this is, at least nowadays, is that if you don't know this already, Delaware does not have a state income tax. The way they make their money is through all the services they provide to corporations. And so they treat this like a business. They keep the law up to date. They have a very professional Secretary of State's office, which can get you all the documentation you want, but you're going to pay through the nose for it. And they charge for just about everything. And it's usually more expensive than in other states. But you're taking advantage of the service they're providing you, which is a very detailed set of laws and procedures. So most public companies are formed in Delaware, though not all. And like I said, the VCs like the ability to predict outcomes, so they prefer Delaware as well. Okay, so that's all the background. A little bit about securities law, a little bit about Delaware C Corps. So what is equity financing? The idea is you're selling an ownership in your interest in your company. A corporation, it's stock. You need common stock or preferred stock. Limited liability company, it might be called a unit. It might be called a membership interest. There's a couple different ways to delineate it. And every piece of equity can be broken down into two aspects, right? It can be broken down into the voting aspect, the voting right, and then the economic right, the ability to receive distributions or dividends. And you can sell those things separately. You can quite literally sell non-voting stock that just has an economic right. You can sell voting stock that has no economic right. You could divide a single piece of stock into its separate rights to sell. So it's very interesting to know that. And so everything we're going to talk about, crowdfunding, coin offerings, whatever, it is all based on variations on a theme. At the end of the day, you can only sell two things. You can either raise debt or you can sell equity. And that's it. Now, there's variations on those themes, but fundamentally, when you're raising money for your company, those are the two ways you're going to get it. We'll talk about pure donor-based crowdfunding a little bit later. That's slightly different, but traditionally the two ways to raise money are selling debt and or selling equity and raising debt. There's also hybrid methods called like a convertible note, or you've probably heard of a SAFE, a simple agreement for future equity. And what you're doing there is you're selling, in a convertible note, you're selling a debt that later converts into equity upon a major fundraising. So young companies don't want to value their company early. They get too low of value for it. You don't want to sell stock right away, so you sell convertible debt, or you sell a simple agreement for future equity, or SAFE. And if you're interested in SAFEs, go check out the Y Combinator website. They have sample SAFEs up there, and they're the ones who developed the original SAFE. And basically what this does is it allows people to put money into your company now, and then when you actually do a major venture capital financing, that money gets converted into the equity that's sold at the financing. So you get to delay the actual money turning into equity. So, okay. Get that, equity financing. The benefits of equity financing. So the downside is you're giving up control. The benefits is you tend to get large amounts of capital than you might get in a debt financing. Ideally, you're getting what we call smart money, right? You're getting money, you're not just getting the benefit of the financing, you're getting the benefit of the investor. And hopefully that investor has experience in your industry or experience in entrepreneurship, or has something else, potential sales contacts or sales channels that they're bringing to the table they can help benefit your company with. So you're getting more than just the money. They can provide mentoring and these contacts and resources, and possibly exposure to additional experienced personnel if at some point you need to hire a professional CEO or CFO or somebody else. And so really you need to be looking when you get to equity financing as to what the investor can bring to the table, and not just necessarily take money from them. Okay, so we're going to talk a little bit about friends, family, angel investors, venture capitalists, right, and their different motives. But the most important thing you need to remember is that everybody invests for a reason, and they all have motives, and it is super important for you to be on the same playing field as your investors, and to understand what their motives are, and for them to understand what your motives are. More than anything, more than all the specifics, this is what's going to define your relationship with your investors. And like I said, it's a marriage. The investors are involved in your company, and if they are not happy, they can make life very difficult for you and your company. And so it's important up front that everybody fully understands and is truthful and honest with each other. And if you ever get the feeling that you're not getting the complete truth from somebody, don't take their money. I cannot, you should always be honest with investors. Investors should always be honest with you, but I cannot stress this enough. I've seen bad investor company relationships destroy companies within 6 months of the financing. I've seen good investor company relationships just launch companies into the stratosphere. And so I think that it's very important that people really understand the motivations, and for you to understand your own motivations too. It's not something we talk about very much, but really having an idea of what you want from your company, like I said, takes us to where investors are. If you think that you want to build a cash cow, but you don't really want to give up control, and you don't want to be forced to sell your company, meaning you don't know when you might sell your company, but you don't plan on it, or at least not in the next 5 years or something, then frankly, venture capital financing is not for you, right? Because the whole point of VCs, and frankly, most angels investing in a company, is to make a return on the company. And that return usually comes at the sale of the company or some form of going public. And if you don't plan on selling your company, then there's an inherent conflict there that is not going to work out well for anybody. So understanding your motivations and the motivations of the investors, perfect. Okay. So I'm going to talk about the next few slides just here on this slide, and then we'll sort of skip over them as we go. First round is usually friends and family. Like, where can we get money from people who just want to see us do well, right? And who can provide maybe small, unless you have a very rich uncle or something, a small amount of financing that can help us get to the next stage. And so you look at friends and family, they generally, most of the time, not always, most of the time, they're usually not sophisticated in terms of financing. And so they're interested in more simple financings, right? Convertible debt's very, very useful here. A safe might be useful as well. Sometimes they just put some money into the company. Sometimes it's just pure debt. They don't really have an exit strategy, right? They're not necessarily, they want to, usually it's based on seeing you do well. It's not as much about getting their money back and getting a return. So they may not be looking for you to sell within a certain amount of time. And then their time horizon for exit is very long, right? Maybe indefinable. Angel investors are sort of the next stepping stone towards venture capital investment. Here we have sophisticated people who have a certain amount of wealth. They've done well in other industries, maybe in your industry. They start bringing stuff to the table. And so their sophistication is higher. The terms of their investment may be higher. It may still be convertible debt or a safe, or usually it's not a full round of equity financing yet. Usually they want to wait till the venture capitalists come in. But they have a time horizon for exit. They're investing with the idea that they're going to make their money back. And so you get angel investment. Most times you are on a ticking clock. That clock may be 8 years out, but it's still there. And that's something you have to keep in mind. And this is where you're going to start looking for that smart money, right? You want angel investors who care about your company, who want to mentor it, who want to provide something that's going to help your company grow. And again, it's important that everybody be on the same playing field. Venture capital, next step beyond that. Serious amounts of money, extremely sophisticated investors. They will provide the terms of the offering. You're talking equity level investments, and they have a set exit strategy and a time horizon. Usually it's less 3 to 5 years or so. And those venture capital investors are definitely seeking investment. And from the time you take that money, you are on a ticking clock to sell the company or go public, because they have to get returns to their investors. So it's very important that you understand their motivations of each. Friends and family, you sort of find those people. Angel investors, there are lots of angel investor groups. They are AIF in the Connecticut area, the Angel Investor Fund. There's angel groups up in the Boston area and in New York and other places around the country where they aggregate angel investors together, and you can register and make presentations to those groups and try to find angel investors that way. You can meet them through attending events. You can meet them through university groups. UConn has a number of programs like that. You can meet them any number of ways, but it's, you know, angel investors are usually a little bit more organized and can be found out there. Venture capital, you know, sometimes angel investors will introduce you to venture capital, but otherwise there are a lot of venture capital funds. A lot of them have various specialties of industries they invest in, and they're very relatively easy to find on the internet. And as well as anybody familiar with the area, can probably, you know, in the industry can probably make some introductions for you. So that's the traditional route of equity financing. So one of the things you're going to find in the back is a outline of the kinds of things you will see in venture capital investment documents. And the reason why I put that there is I used to sort of present on it, but it just takes too long. And I'm still barely touching the surface, but they're very sophisticated documents. And it's important for any company to understand what it is they're giving up and the various ways the documents impact that company. And so I put that in appendices. Feel free to look at it. Feel free to ask questions about it, but I want you to be generally aware of it. Again, we've gone over this, the why you need to consider an investor. So here we've got a few slides on the actual process of the types of agreements that you might see. And there's really nothing else to cover there. But it's important to know that at least with friends and family, you're going to provide the documents, the investment documents. With the angel investors, you might provide the first round documents, but it will be negotiated a little bit. And with venture capitalists, they will provide the documents, and you'll negotiate from there. Okay. So those are the traditional ways of raising financing. Any questions to this point? Okay. We'll continue on. So the next step is there are other methods of selling securities, right? You have your private placements, which is basically what we were just talking about, and it's important to understand how the system works. Private placements are sales that are not publicly advertised. If you publicly advertise a sale of securities, you are conducting a public offering, and you're subject to all those laws. And if you publicly advertise the sale of your securities and you're not doing a public offering, you're practically a criminal. And you'd be subject to other fines and other things that when there actually is a potential criminal statute. So over the years, the SEC has created hybrids, right? A big one is Reg A+. It was basically the idea that you could test the waters. You could create a website that sort of announces that you're going to raise money. You could raise a lot of money, so it allowed for you to raise up to $75 million in a 12-month period. And it's largely exempt from securities law registration. You do need to file some stuff with the SEC, but they have an expedited review process for it. It is it's basically like a cheaper public offering in many respects. My experiences with it is actually in places where I bought various products, I've received emails. You may have too. I once purchased a product called the Slide Belt, which is like a ratchet belt for your pants. And I thought they were kind of cool. And then about a month later, I received an email saying, hey, Slide Belt is raising money through a Reg A+ offering. And if you were a buyer of the product, if you want to invest in our company, here's what we can do it. We're raising another 50 million. So, we're going to do that. And, the expenses are more than a private placement. You're probably, depending on how it goes, maybe you're talking $50,000 to $100,000 in legal expenses plus accounting expenses, but you also raise a ton more money than you normally would in a private placement. So you also get to, you get a broader variety of investors, and generally not one of those investors is a controlling investor like you'd find with a venture capitalist. And sometimes venture capital backed companies will do a Reg A plus offering if they find that's a good way to go out and get capital. So it's worth considering. As a matter of fact, one of the just last year, it just went effective this month, but last year they passed rules that raised Reg A plus from a $50 million limit to a $75 million cap. So that's pretty cool. It's useful. It's something to think about. And then we get to the idea of crowdfunding. So to really explain the impact of crowdfunding in the United States, I kind of need to take you back a little bit. So bear with me on this little history lesson through the Great Depression. So back in the 1930s, just prior to the Great Depression, people were selling stock and ownership interest in companies willy-nilly. There was no regulation around it. People were making great promises, and they often involved what they call pump and dump schemes, right? Where somebody would pump up and talk up the stock, and then a person would go, and then somebody else would buy it, and then the stock would just plummet because there really was nothing behind it, right? It was complete fraud, but there was no regulation around it. And back then they used to call that promising somebody the blue sky. And in fact, today we still call it blue sky laws. And so when the SEC was created, in 1933, the Congress passed two acts, the 33 Act and the 34 Act, which largely created the SEC and governed its abilities to monitor how securities are sold. They were working with limited tools to try to prevent all the fraud that caused, in part, the Great Depression. And they basically limited it two ways. Number one is they limited communications. They said, if you're selling stock publicly, you need to go through a registration process, and we get to see all your communications with investors, and you have to be careful in what you can say. And they put all these regulations around it. So they limited communications. Second of all, they limited the money that could come in. They said, you know what, you can only invest in certain types of offerings if you're already wealthy. Because in theory, you're wealthy because you know what to do with money. And if you're not wealthy, you may not know what to do with your money, and therefore you need to be protected. Now, you can decide for yourself whether or not that's a smart scheme or not, but that's, these are sort of what they use to help guide things. And crowdfunding, if you think about the way crowdfunding works, it just destroys these two areas of community, these two barriers, right? Number one, crowdfunding is opening up funding to the crowd. It is all about communication. It's communication to everyone about anything at any time. So it completely breaks down the communication barrier. Second of all, it's about opening it up to new types of investors, not just your traditional wealthy investors, but to get, the proverbial Joe the plumber off the street to put money into your company, so that anybody can participate in these markets, right? It's democratizing markets, which is exactly what the SEC was created to prevent. So you can imagine how well crowdfunding has generally gone over with the SEC initially. As we're democratizing, the experience of selling securities, we are now getting away from the protections we have put in place due to a prior democratization, which was an unregulated market. So the balance for them is, how do we create a regulated market that allows for democratization of finance without creating a Wild West free-for-all, right? And it's been an interesting journey. So we'll get to equity-based crowdfunding in a moment, which is really what they're concerned about. But there are three other types of crowdfunding that we should be thinking about, and these are all available to you. First of all is what we call microfinance or microloans. These are loans for small amounts of money through different organizations. I think there's, in Connecticut, I think there's a Litchfield Hills regional loan program for $25,000 that is a very low interest rate for new companies. Probably the biggest one worldwide known is Kiva.org. And what I think is cool about Kiva, if you're an impact investor type person, is they make loans to mostly, they've expanded, but mostly to people in traditional third world countries who are creating small businesses and who need help going on, people who, to whom $3,000 can be the difference in them starting a business. And the minimum loan is 25. I've done this many times, and You put in, they aggregate all these, you choose your projects you want to invest in, it gets aggregated with other people, right? Crowdfunding, they aggregate all the investments together, they get it out to the companies, and then the companies pay it back over time. And in fact, Kia has a 97% repayment rate, which a lot of banks would kill for. It is a really, really good program. And what I think is cool about this is that it's in some ways, these are completely non-bankable companies. These are, and the businesses are not sophisticated. Many of them could be as simple as basket weaving. It is investing in people. And the repayment rate shows how important and dedicated those people are to success. And it shows really a different level of bankable people in my perception. So microfinance, microloans is one way. A greater moving next step up, we start looking at sort of another type of debt crowdfunding is peer-to-peer loans or social lending. And this was created largely, originally it was created around people trying to build out their cities and trying to figure out what do our cities need to improve. And we can get a whole bunch of us wealthy people together, pool our money and make loans to people to do things. So one of these programs started in San Francisco, prosper.com, and started out with things like, well, what do we need, in the Castro district? We need this restaurant here. So let's go find somebody wants to start a restaurant, we'll fund it. And we'll aggregate our things, and we're not a bank. We will get rid of the bank. We'll just do the loan directly. These have expanded significantly. So you've got things like prosper.com and Lending Club, billions of dollars of loans. Prosper.com does approximately 2,500 loans a week. And this is all, what it's done is it aggregates capital from wealthy people and from people like you and I, and we can all make choices to who we want to loan to, and then when they hit a certain amount, they make the loan, and then you get paid back over time and with an interest rate. And it's an interesting way. Of course, as you can imagine, these numbers are starting to get up there. They're starting to get noticed by banks. Banks aren't too thrilled about peer-to-peer lending because it cuts them out and doesn't have the same overhead costs and fees. They also doesn't have the same depository insurance and other things that banks have. So, we're always keeping an eye and see what Congress does, if anything, about peer-to-peer lending. But so far, for a while now, it's been largely unregulated. So very interesting. And then the final, before we get to equity, the other type of crowdfunding is the one that you're probably most familiar with, which is what's called donor-based or reward-based crowdfunding. That's Kickstarter. Your Rocket Hubs, your Indiegogos. It is your, it's where basically people, and this is where lawyers have very little imagination. It's people essentially giving money to for-profit businesses in exchange for something that, sometimes in exchange for nothing, sometimes in exchange for a credit, like on a movie, you get a credit at the end, or maybe you buy initial version of the product if they're trying to sell. Maybe it's just something you want to support. And so when I said before, all types of fundraising, either debt or equity, this is the one exception. Equity-based donor-based crowdfunding was people giving money to things they wanted to support because they wanted to support them, and they really weren't expecting anything in return. That has slightly changed. It's now almost like buying a product in some ways when you do it, but it still has that fundamental nature. And I think many people in financing and lawyers as well just could not imagine that this would make an impact. Who wants to give money to for-profit companies? But people do, and I've done it. So it's a fascinating process. And if you have a product, if you're a set product and you have a story to tell, donor-based crowdfunding can be a very good funding avenue. But you need to be able to connect with people, and it is very much a social media and marketing exercise as it is a financing exercise. It's a very different structure. And finally, we're going to talk about some statistics here, but we're about to get into equity crowdfunding, which is, again, selling securities to the crowd online with fewer restrictions. And like I said, this was the thing that was an anathema to the SEC. And we're going to talk a little bit about how that came about and what it means today. But crowdfunding is important. current estimates show it's added about 65 billion to the global economy. The U.S. has about 191 combined crowdfunding platforms. This is both debt and equity. Crowdfunding itself is supposed to go to 300 billion by 2025, even including 2020, which we thought was going to be an off year and really wasn't. Equity crowdfunding has grown significantly. So equity crowdfunding, when it started, was really held back, and I'll talk about that in a moment. But last year, it went up by over $100 million in equity crowdfunding in the U.S., so it did 214 last year in equity crowdfunding for 1,035 companies, 514 million since 2016, which is when it went into effect. And we had a 75% of increase in investors last year. It's increasing rapidly. And it did so in what many people might have thought were a down year. And it doesn't sound like a lot. $250 million is not a lot of money in terms of overall, what you expect for company investment. But it is increasing, like I said, it's increasing rapidly year over year. And it's about to increase even more. And I'll tell you why. And then we compare that to venture capitalists. Actually, VC had a good year last year. They actually did more deals than the year before. They did $156 billion in deals. Early stage deals accounted for 41 billion of that. Most of the rest was really sucked up into large or late stage transactions, which is pretty common. Most venture capital investment goes to large and late stage companies, not early stage companies. But you're at roughly you get to that 35 to 45%. That's for early stage. That's pretty good. Well, sorry, 45%. If you're at you're at like 25 to 35%. That's pretty reasonable. Okay, any questions to date before we talk about equity crowdfunding? I know we've been running through this really quickly, and I'm talking to a screen, so it's very difficult for me to tell how many people are still awake out there.
There's one question, Dave. It might be best to cover at the end. It's asking for advice about a seed stage and what an initial cap table should look like.
Sure. I will. Yes, let's touch that at the end. I will happily do that. That's a great question, though. Equity crowdfunding. Okay, so this was passed by the Jobs Act of 2011. It took the SEC 5 more years to wrangle with it in their heads before they passed rules approving it. And again, what are we concerned about with equity crowdfunding? Fraud, right? The idea of people pumping and dumping stocks. Kickstarter, as a donor-based crowdfunding, had very, very few examples of fraud. And with the way the equity crowdfunding rules have worked so far, we don't have any examples of fraud, right, through equity crowdfunding portals. So we talk about why it works, because now we're opening up we're getting new whole markets of people that can invest, right? And that is very important. And it created a new way for people to invest. And the way they did this is the SEC made everything go through what they call online portals, essentially specific websites that are approved by the SEC and by FINRA to handle equity crowdfunding. The biggest one is WeFunder. And if you're interested at all, I recommend you take a look at it. So the crowdfunding rules went into effect May 16th, 2016, right? And they included a number of different things. These online portals, the unlimited number of investors, and that foreign investors could participate. But then late last year, there's things that have been kind of holding the equity crowdfunding rules back. Number one of which was you could only raise a certain amount of money in a 12-month period. It was at 1.07 million that you could raise in any 12 months. And many people found that this just wasn't enough. Even we're going to answer a question about seed funding. Even seed funding these days, a seed funding round can be up to $2 million. And it used to be the seed funding round was something less than $1 million. Being able to raise $1 million in an open market just wasn't enough to fund most companies. And there were other restrictions. There's restrictions on the amount of money a person could invest and so on. Well, these rules that they went into effect last year have eliminated this. So now you can raise $5 million every 12 months starting this month. And that is going to change the equity crowdfunding numbers significantly. I think as this takes off even more over the next few years, you're going to see it go from 214 million in a year to much higher numbers, and I expect gains in the hundreds of percents. You can now do test. Now you can kind of test the waters. You can actually put something up on a website that says, we're thinking about doing an equity fundraise through crowdfunding. Here's some information. What do you think? And you could never do that before. You were legally prevented from talking to your potential investors. And so when you went into the fundraiser, you weren't sure what was going to happen. Now you can do this test the waters, which makes it a lot more usable. Right? You can also aggregate. The problem, one of the big problems that people have had is, hey, now I'm getting 100 investors. What am I going to do with all these people? Like I'm a $3 million company, but I've got 100 investors and I have to send out investor notices to these people. How do I do that, et cetera? Now you can aggregate all of them into a single special purpose vehicle, an SPV, which is basically just a separate company set up. They all invest in that company and you can deal with it all in that way. It makes everything so much easier. There's no funding limits anymore for accredited investors. Accredited investors are those wealthy people I talked about. There's certain rules that the SEC has that says if you make over $250 a year or you have $1 million in personal value, not including the value of your house, then you are accredited investor. And that's how they determine who is a wealthy person for terms of who can invest with impunity. Well, there's no more limits for them. And they've raised all the funding limits for non-accredited investors so people can invest more money into the market. So all of a sudden, equity crowdfunding, starting literally this month, is starting to look very attractive. And frankly, it provides competition now to seed round investments and early stage venture capital money. And so, and you can do it, frankly, when we talk about buy, you take debt, is you don't give up control. Equity crowdfunding, you can sell what you want, and which in most cases means non-voting stock. And so you're still not giving up control. And there's something to be said for that. So this is very exciting. It's huge for lawyers like me who are very interested in this market and want to see where it goes. It could be very important for you and the people you know. So keep that in mind. I talked about a little bit about.
Excuse me, we do have a question.
Yeah.
Does crowdfunding usually grant voting rights with equity shares, and wouldn't that create an administrative burden for operating?
Absolutely. It would create a massive administrative burden, and no, it usually doesn't. And that's what I was just saying. We don't. Most crowdfunding sales do not grant voting rights because of the burden it would have. And in fact, the ability to not grant voting rights is one of the great things about it. Is to get in this money without granting voting rights. And just something, what's been holding the industry back. I mentioned the fact that there's the $1 million limit. Also, coin offerings, token offerings, they were very big over the last few years, and they've decreased recently. I think it was just down to 16 offerings last year that were completed, initial coin offerings. But because those took off, the interest in equity crowdfunding had died down, and so now we're about to start seeing the reverse of that. Okay, so I've got two crowdfunding examples for you just to give you a sense. The first was the very first offering done in the United Kingdom. They passed their laws in 2012, and they created a partially government and private/public entity called Crowdcube that allowed for offerings. And this one company, whose name was Escape the City, decided they were going to be one of the first companies to crowdfund in the UK. And Escape the City's business plan was that if you worked at sophisticated work in the city, you made a lot of money there, they would find you a job in the countryside doing what you currently do, and you could still make a lot of money, but you'd have to be in the city. Now, I don't know if that's the greatest business plan ever. I honestly haven't followed up on that company. Maybe they're doing great. But they got offers from the two largest VC firms in London at the time to take on VC money. And they decided to try equity crowdfunding. And for a few reasons. Number one, they didn't want to give up control. Number two, they could take the exact specific amount of money they wanted without having to take too much money or give up too many shares. They decided they needed 500,000 pounds. And they got that. They got 600,000 pounds in 13 days. Let me tell you, the average VC deal, I mean, it can take you a long time to find the right VC. And then once you find the right VC, it can be anywhere from usually 2 to 4 months to close that investment. 13, to close an investment in 13 days is amazing. To do it with very little paperwork, because again, everything's signed digitally and it doesn't require as much effort. You're not giving up as much rights as, say, a venture capitalist would have, to what a VC would have, is also incredible. And that was the benefit of it. That's why people would choose equity crowdfunding. I can get money. I don't have to give up control, and I also don't have to give up like a board seat. I don't have to have annual accruing dividends. I don't have to have a mandatory redemption offering whereby if I don't repay the VC in a certain amount of time, they can force me to buy them out or they take control of the company. All these sort of things. So it's a very interesting, like I said, democratization of finance. Another example I want to use is one that's actually probably just completed. These are clients of ours. The Raise Green platform is a equity crowdfunding platform that focuses on green energy projects. Block Power is a company that went through the Raise Green platform to make an offering. And they have an existing company that installs solar and MCHP, micro combined heat and power platforms in homes in depressed areas. And the homeowners get this and they pay them back over time. The investors are effectively just buying into these loans, right? The loans are aggregated by Block Power and the investors buy into the receipts from the loans. And it's essentially a debt offering. The key of this is to remember that US crowdfunding does not have to be pure equity based. You can structure it the offering however you want. Now, some offerings are going to sell better than others, but you can create a debt offering. You can let people participate in your revenues instead of, and you could eventually buy the shares back from the revenues. You create the terms of the funding. And that is a power that companies have not really had to get significant amounts of money. Always the terms have been set for them. So something else to consider. And next to last, I want you to look out for alternative funding. If you are the type of person who is interested in social impact investing, or you are looking at it, you are a social impact company, or what's known as a B Corp or a benefit corporation, people are out there developing new forms of investment structures. I see this more now than I've ever seen in the past. Back when we had, for the longest time, it was just venture capital documents and convertible notes. And that was it. A person got convertible notes from friends and family and angel investors, and then they got VC docs. Now there are groups that are putting together all types of different types of investing. They're looking at how can we invest in companies that maybe aren't looking to sell at the end of the day. And how can we get a good return from that? And it may not be as high as a good VC return, but it might appeal to different types of companies and different types of investors. And so these are some places that you can check out and take a look online and read through the web pages, and you'll see some interesting things. And there are more organizations out there. But if you're feeling bold and you want to try to look at different types of investment or taking on different types of investment for your company, this is a great way to do it, or at least to think about it. I will tell you one thing I'm seeing more often, and this is, I think, very unique, is I've seen more worker cooperative companies in the United States lately. And this is a structure where everybody owns the business. Everybody who works in the business owns the business. And it requires a lot of detail. It is not an easy structure to work. Everybody who's in it has to be very dedicated to making that work. But these are companies that are still seeking financing as well, and they need alternative types of financing, and they're finding more things available to them. And the last big point, and this is, I think, very unique, is I've seen more worker cooperative companies in the United States lately. And this is a structure where everybody owns the business. Everybody who's in it has to be very dedicated to making that work. But these are companies that are still seeking financing as well, and they need alternative types of financing, and they're finding more things available to them. to make today is about cryptocurrency, and nowadays non-fungible tokens, right? So cryptocurrency, of course, is the ICOs, the initial coin offerings. Like I said, those have been decreasing. There were 16 in total last year. They take about as much money as a small IPO does to get off the ground. They're not as efficient as they used to be, not quite raising as much money as they used to be. But I still feel the need to mention it because some people have found an avenue to financing through cryptocurrency. NFTs are, pretty new. They're very popular right now. They're the hot thing in the market. The Wikipedia definition is here, but essentially it's a blockchain way of tracking a digital asset, right? It basically says that, you not only own this digital asset, which maybe you, but also other people could access, but you're the one who has the NFT to go with the asset, which identifies your ownership and is basically non-breakable. And so that's starting to get very appealing, especially to art, any type of art. But music, video games. Recently, they just sold the first tweet from Twitter with an NFT. I think somebody paid 2.9 million for it. But the idea is, how can artists make more money and raise money in today's industries, especially when everything is copied and displayed online? And how can somebody just say, I am the owner of this art, and have it done in a very trackable way? NFTs are the answer. So one more thing to consider. So all of this is to say that, we just covered a lot in about 55 minutes. It is a massive area. There's a lot of different routes to funding. This presentation 10 years ago, and I was giving it 10 years ago, it was so simple. It was much smaller. What we have available to us today is the amount of routes to financing, the amount of creativity that can be involved if you have the stomach for it is pretty amazing. Just be aware of it all. Don't get limited into one avenue. Really think about what your goals are. When you meet investors, find out what their goals are and make sure there's a match. In some ways, it's that simple, though it can take a lot of time to get there. So listen to your advisors, and and find good advisors. And to the extent that Martha Kalina can help you, or Reset, or the district, we're all there for you. We can put you in touch with other people. We're happy to just mentor you and talk you through some points and go from there. And so we're going to wrap it up. I'm going to invite some, I'm going to take on some questions and all of that. I have a few little cartoons here. I'm a big fan of the Muppets. And so seeing them in crazy situations always helps. And I always thought Dilbert had a very good take on venture capital. So there's appendices. There's more documents coming to you. It's only been 1 hour and you've been assaulted with all this information. Andrew will read off questions. Please feel free to stick around for them. I'm also happy to answer things later. And I hope you found this helpful. I hope it's been good for you to listen to. It's very hard for me to get any sense of things talking to a screen. I miss doing these things in person. But just know that as you go through a financing process, whether you're the investor or you're the company being invested in, there are people there to help you. So, Andrew, did you want to read off that first question again?
Sure. And since then, there's also been a follow-up. So the first question was advice about a seed stage and what an initial cap table should look like.
Okay. So the term seed stage is interesting because it used to just be, once upon a time, it was just basically like, initial investors and then a Series A. And then we got the idea of seed stage investment, which was usually convertible notes or safes, which would bridge the gap between friends and family and a full Series A. A seed stage can be anywhere from $100,000 to $2 million. The thing is that it very much depends on what kind of company you are, what your structure is. Some companies are going to be investment heavy, and so doing a large seed stage can be fine. If you look at like a new pharmaceutical company, they're going to get tens of millions of dollars as they go through their various funding process before they produce a dime. So taking on a large seed stage is fine. But if you're, say, a small product company and you still want to eventually go through the VC process and eventually sell the company, taking on a seed stage that involves like a convertible note or safe financing, you probably want to limit it to $500,000 or $600,000, because every time you give a convertible note or a safe, they have a discount attached to them. When they convert later during the Series A round, they convert at a 20% discount. And once you get beyond that 600,000 or so, that discount can create massive issues at the Series A round, a massive dilution to both the Series A investor and especially the founders. So the size of your seed stage will depend on what kind of money you're raising and who you're raising it from and what your company goal is. Like I said, most seed stage tend to be this convertible note, safe based type thing. It can be a sale of seed preferred stock, which is like an early preferred stock. And that's usually, if you're at the $1 million and over, you might be selling seed preferred stock. And seed preferred looks a lot like Series A. The terms are slightly better, but you're actually selling equity, which means you need a valuation. But if you're selling over $1 million, if you're taking in $1 million, you probably have at least a valuation of hopefully around 4 to 5, and that can make it worthwhile. What your cap table should look like, a lot of it depends on the investor. See, one of the big problems of crowdfunding is that if you get 100 investors in crowdfunding, your cap table looks crazy, right? And some traditional VC investors don't like to have all those other investors on the cap table. It's one of the reasons why allowing these special purpose vehicles in crowdfunding might help people move from crowdfunding to venture capital. The other thing is that, again, if you have a ton of convertible debt instruments on your cap table, you have to account for that when you're doing, your conversion calculations. And that can, so you just have to be careful. But usually VCs don't mind that as much, as long as the dilution effect isn't crazy. Or if you're taking the dilution effect entirely upon the founders and the VCs don't get diluted by it. So it's, but yeah, so your cap table, you definitely want to see the founders. You might see some early stage investors. And cap tables, I hesitate to get too far into that though, just because I want you to know, cap tables tend to be a result of company operating history, right? Companies have to do different things at different times to get money. And so, not everybody can get money on demand. And so their cap tables might look a little bit crazier than others, which means that we might have to go and fix the cap tables later, or try to either buy out certain investors or try to consolidate certain investors, to do other things to try to make cap tables more accessible to a potential later stage investor. But you can't worry about that at the time. You just do the best you can. What was the follow-on?
Sure. First, someone is raising a hand or was raising a hand. So if you do have a question, please write it in the question and answer box in your toolbar. So, and we'll get to it. Thank you. The next question is, how are reverse vesting shares accounted for? And do you leave unallocated equity with anticipation of dilution, additional owners, or should you always assign all ownership and redistribute every time you distribute equity?
Okay. So first of all, I'll get to the vesting bit in a moment. But so it depends on what kind of company you own. Obviously, company structure is a little bit different for different types. So for instance, in a traditional corporation, you have stock. And as part of that stock, you have authorized and you have issued. So your pool of authorized, you might have 1 million shares, but you only issued 100,000 of those shares. That means you've got this pool sitting there, right, that you can draw from. And, when traditional structures, traditional Series A VC investment structure would be 80% outstanding and 20% left in a pool to compensate employees and have equity incentive plans, right? But you might have to do that before then, before you get to the VC structure. Equity compensation is very important, even for founders. And often people start vesting their ownership right away. And they put vesting plans in from day one. So day one, you may not own 100% of your own company. You might vest it over time. if you have multiple owners. With LLCs, it's a little bit different. If you own an LLC, 100% of the LLC is outstanding at any time. There is no pool to draw from. Now, you could artificially in your head keep a pool there, but legally, if everything is divided up into percentages, ownership interests, and all percentages equal 100% of the time. And so you have a pie and you just keep dividing it further and further. And so in that case, there's not exactly reserve, but you can sort of keep in mind how you want the LLC to grow. And frankly, what most companies do, and what we often do for our clients, is we take the membership interest and treat it as a unit. And then we say, okay, 100% of the outstanding membership interest equals 1 million units. And so somebody has 5 million units and so on. By using that units, it looks a little more like stock, and it's a little bit easier to kind of anticipate for planning purposes. So generally speaking, though, so in LLC, you would be 100% outstanding at every time. And as more units are issued, everybody gets diluted down, pro rata. Whereas in a corporation, you do have these reserve shares, and you can kind of, you kind of see what 100% of the issue would look like, and then 100% of the issued and authorized would look like, and you can plan from there. The other thing is reverse vesting. Okay, so there's a few concepts here, but the big one is what you often see is something called restricted stock, right, or restricted units. And the idea is that I give you units that you, in theory, vest. You get the units on day one. But what vests over time is your ability to effectively get value for those units at a later date. So I give you 100 units today, and it vests 25 units a year over 4 years. On day one, you've got the 100 units, but if you left on day two before the first year was completed, nothing would have vested, and those units would have come back to the company at no cost. If you left after year one, 25 of the units would have vested, and the company would have had to pay you fair market value for those, right, if they wanted to buy back those units. So you'd receive value for those, but the other 75 hadn't invested, and you wouldn't get any money for those. There are some tax benefits to doing it that way. There's a section called 83B in the Internal Revenue Code that allows you to pay all your taxes on restricted stock right up front, and that might save you money over time. I'm happy to talk about that offline, but anyways, that's where you tend to see reverse vesting. It's actually restricted units and restricted stock are probably one of the more common things these days. I mean, unless the company is large, I'm seeing stock options less and less and less. Okay.
What are phantom equity units in an LLC, and how are they used?
Sure. So here's the trick with an LLC. You cannot be both an owner and an employee of an LLC that's taxed as a partnership. And just about every LLC is usually taxed as a partnership, because that's why you choose an LLC, is to get that flow through taxation, right? The fact that there's no entity level tax like there is in a C corporation. So the downside of doing that is that for IRS purposes, you cannot be paid. If you own interests in an LLC, you're an owner. You are self-employed. You cannot receive a W-2. You cannot receive subsidized benefits. So if I'm a W-2 employee of a C Corp, for instance, the company might pay part of my healthcare plan, and that's great. I never have to worry about that. But in an LLC, if the company pays part of my healthcare plan, that's treated as income to me, and I owe tax on that because I'm self-employed. And I also pay self-employment tax, which is slightly higher. It also means that the entity doesn't take out any of my taxes. I have to do it all myself. I discovered all this when I became a partner in the law firm. I moved from becoming a W-2 employee to being self-employed. And now I pay quarterly estimated taxes, and I have to pay self-employment tax and so on. And now I still probably get more money than I would in a C Corp, but the process is very different. And if you're used to being a W-2 employee and you move to self-employed, it's difficult. And you probably need to pay a person who's self-employed more to make up for the fact that they're not receiving subsidized benefits. And so, so that can make it difficult to give out equity ownership in an LLC to employees. There are ways around it, but they're kind of crazy, like they're really weird structures. So often what people do to fix that in LLC is they create phantom plans. And what a phantom plan is it basically is just what you might refer to as a tracking stock. It follows one unit of the company or one share of stock or one unit of the company and the value of that unit. And if the unit value increases, then the person gets a cash bonus equal to the increase in value of that unit as if they owned it. The difference is that it's not an actual capital investment, right? They don't actually own stock. They're just getting an ordinary income cash bonus, which again, subject to ordinary income tax, not capital gains. But they do get cash bonuses based on how the ownership is performing. Or if the ownership would have received a distribution, then they get an equivalent distribution. And that way the employees get to remain a W-2 employee, but they also get to participate in ownership. It's just sort of an indirect way of doing it. Okay.
All right, a couple more. Is issuing bonds a possibility for a company? If so, what are some of the advantages, disadvantages over convertible debt structure?
So yes, issuing bonds is essentially like issuing debt. And as I was noting with Block Power, you can do that on a crowdfunding website now. A debt can still be a security for legal purposes. So you still have to abide by securities laws. But the benefit is, as usual, you're not giving up control. You also have set payments to pay back to the bondholders. So you have a very solid idea as to how it's going to impact your cash flow. It is, assuming you get enough people to take up the entire bond offering, it has a very predictable effect on the company. It's not variable. It's not going to change over time. You can show it to a bank. If you have to provide a bank financials, you can show it to investors as part of investor financials. It's a wonderfully predictable tool to use. Now the question is what your interest rate has to be and whether or not you have enough ongoing cash flow to make the payments and what happens if you can't make the payments. And all of those might be more serious issues, but a bond offering or a debt offering by a company is perfectly legit. It is just a matter of whether having that amount of predictability is both suitable for the way your company operates and of a benefit, a beneficial way for you to raise money without giving up control.
Okay, last question. Could you also give an example of a cap table term sheet specific to angel investors?
So again, something going to angel investors is gonna, you're giving me an idea that maybe I'll look to see if I could include something in future offerings. I'll have to put something together as a sample. But a lot of people's cap tables look differently than others. But anyways, going to angel investors, it should look very simple, right? Because angel investors come in relatively early on in the process. So at most on your cap table, you should have your founders and anybody else who's receiving vesting equity as an employee. Maybe you'd have some friends and family investors in there at most. But you're generally, I mean, this is not set in stone, but you're usually talking less than 10 people. And usually no entities that invested by that point. Again, just individuals. And like any other cap table, it should show what the form of their investment is. If it's a convertible note, it should have a prediction of what ownership percentage that or how many shares that person would hold if it converted today at today's value. And you sort of put in a model value there to just so people get a sense, like, okay, if we said today's value is $1 million and all convertible notes converted, this is what everybody would hold. Because at the end of the day, that's what the investor needs to see, right? That's what they need to understand. So it needs to be the amount of money people put in, what they own, and what it would look like maybe with a couple sample waterfalls, at 1 million, 2 million, etc. This is what people would have in the company. That way, the angel investor gets a very good example of what the company looks like today and what it will look like with them on it. usually in my cap tables, I usually have, that would be the top cap table. In the middle would be the formula for the convertible note and how to build that in. And at the bottom would be a post-financing cap table. So if we brought an angel investor and they came in at this is what the next one would look like. So. Andrew, any others?
Someone just wrote a great comment. There is a great free example Excel worksheet and seminar from the ACA to show the effects of initial angel and VC investors.
Great. Did you see the ACA?
It says ACA, yes.
Okay. I also recommend that you check out nvca.org, National Venture Capital Association. They have a number of free resources on there. You have to give them an email address, but after that, you can look at their venture capital docs and so on. NVCA, they have sample term sheets in there. Again, I recommend checking out Y Combinator for a version of the SAFE, the Simple Agreement Future Equity. Just note the SAFE has changed significantly over time. It used to be much more company favorable, and nowadays not so much. So just know that there are many different versions of safes out there, and you can take a look at that. If you're interested in crowdfunding, take a look at some of the websites out there. WeFunder, Startup Engine. If you're energy based, you can look at Raise Green. And there's just a number of different places out there. You can get a sample of what it would take to go through that process and create a new funding method. Okay.
That's it.
That's it. Okay. First of all, thank you very much for those who asked questions. I really appreciate it. I hope I answered them. And if I did not give you a good enough answer, let me know. I will get you more. And thank you all for coming. We very much appreciate it. I hope you learned something today, and I hope to see you at future presentations. Thanks a lot. Have a wonderful Tuesday.